you are in debt right now. Maybe you know exactly how much. Maybe you've stopped counting. Either way, the system is working perfectly, because here's what nobody tells you. Debt in America isn't an accident. It isn't bad luck. It isn't a personal failure. It is a carefully engineered psychological trap, built over decades, refined by some of the sharpest minds money can buy, and deployed specifically against the average American brain. This is the story of how that happened, and why you were never supposed to figure it out. Let's start with a number. Americans are currently sitting on over $17 trillion in household debt. Credit cards, auto loans, student loans, mortgages, medical bills. 17 trillion. That's not a statistic. That's a cage. And most of the people inside it have no idea the door was designed to lock from the outside. Go back 70 years. Post-war America. The economy is booming. The middle class is growing. For the first time in history, ordinary working families could actually save money, buy homes, build something real. Banks were boring back then. Regulated, constrained. They couldn't gamble with your deposits. They couldn't sell you 100 different financial products. They just held your money and made loans. Simple, safe, almost harmless. Then the financial industry looked at that growing middle class and saw something different. They didn't see stability. They saw untapped potential. They saw millions of psychologically vulnerable human beings who had wants, fears, and egos, and they went to work. The first weapon they deployed wasn't interest rates. It was identity. In the 1950s, banks and retailers began a quiet revolution. They figured out something profound and terrifying. People don't buy things because they need them. People buy things because of who they believe they are, or who they desperately want to become. You don't buy a car. You buy the version of yourself driving that car. You don't buy a house in that neighborhood. You buy the story you get to tell at Thanksgiving dinner. They hired psychologists, behavioral researchers. They studied how shame, status anxiety, and social comparison literally rewire human decision-making, and they built credit systems designed to feed directly into those vulnerabilities. The credit card wasn't invented to help you. It was invented to create a psychological distance between you and your money. Cash hurts. Handing over a $20 bill activates real pain centers in the human brain. Scientists have measured it, but swiping a card, tapping your phone, that pain is almost completely gone. They removed the friction on purpose, because frictionless spending is uncontrolled spending, and uncontrolled spending means interest, and interest means profit. Enormous, compounding, perpetual profit. Here's where it gets darker. The minimum payment. You've seen it on your statement. That tiny little number sitting at the bottom. 25 bucks, 30 bucks. Feels manageable, right? That is the most psychologically sophisticated trap in the history of American personal finance. Banks invented the minimum payment specifically to keep you in debt forever without ever making you feel like you're drowning. You're treading water. Just comfortable enough to keep going. Just uncomfortable enough to never get ahead. Run the actual math on a $4,000 credit card balance at 22% interest, making minimum payments only. You'll be paying that off for over a decade. You'll hand the bank nearly double what you originally spent on stuff you probably don't even own anymore. That isn't a loan. That's a subscription to your own financial destruction. And they knew it. The actuaries knew it. The executives knew it. They built it that way. Because a customer who pays off their balance every month is nearly worthless to a bank. But a customer trapped in the minimum payment cycle, that customer is a revenue stream for life. Now layer in the credit score, the most brilliant psychological control mechanism ever inserted into everyday American life. Your credit score isn't just a number. It has been transformed into a moral judgment, a reflection of your character, your responsibility, your worth as a human being. Landlords check it. Employers check it. Insurance companies check it. It follows you everywhere. And the system that generates it was designed by the same financial industry that profits from your debt. Think about that for a second. The entity that makes billions off of you borrowing money is also the entity that grades you on how well you borrow money. You are being evaluated on a test written by the people selling you the answers. And the cruel genius of it, to build a good credit score, you have to use credit continuously. You can't opt out and win. You have to play the game on their terms. Use the card, carry a balance, pay on time, repeat. The system is specifically structured so that the only path to financial legitimacy runs directly through the products they're selling. But the credit card is just the entry-level trap. The real long game is the mortgage, the 30-year mortgage. Americans treat it like a rite of passage, like a sign you've made it. But pull back the curtain and look at what you actually agreed to. Buy a $300,000 home with a 30-year mortgage at 7% interest. By the time you make that final payment, you've paid the bank over $700,000. You paid for the house twice. You built an entire second house with your labor and handed it to a bank in the form of interest. And the whole time, every piece of marketing told you this was the smart move, the responsible move, the American dream. The American dream was financed by the American nightmare. That's not an accident. That is design. Now add in student loans. They convinced an entire generation that going into six-figure debt at 18 years old, before you've ever earned a dollar, before you understand compound interest, before you have any concept of what $100,000 even feels like, was not just acceptable, but necessary, required, that without a degree, you had no future. And to get that degree, you had to borrow from them. The student loan industry grew into a trillion-dollar machine precisely because they had a captive audience, teenagers, told by every authority figure in their lives that there was no other option. And here's the psychological kill shot. They attach the debt to your identity, your education, your potential, your future. Defaulting on a student loan doesn't feel like missing a credit card payment. It feels like failing at your own life. That shame is a collection mechanism. It keeps people paying even when it's destroying them. This is what weaponized psychology looks like inside a financial system. Here's what they don't want you to sit with too long. The most profitable American consumer isn't rich. It's not the billionaires. It's the person making $60,000 or $70,000 a year. Enough income to qualify for every product. Not enough to pay it off quickly. Not rich enough to have lawyers and accountants building walls around their wealth. Not poor enough to qualify for protections or discharge. Right in the sweet spot, the Goldilocks debt zone. Just right for maximum extraction. The entire consumer credit machine was calibrated for that person. For you. So what do you do with this? First, you see it clearly. Most people in debt feel shame. They feel like they made bad choices. They feel alone. But when $17 trillion in household debt exists simultaneously, that's not 17 trillion individual failures. That's a system performing exactly as designed. Understanding that doesn't erase the debt, but it does something more important. It removes the psychological paralysis, because you can't fight a trap you think is your own fault. You start winning when you stop playing defense and start playing offense. That means you treat every minimum payment as a warning siren, not a solution. It means you understand that your credit score is a tool of the system, but you can learn to use that tool without letting it use you. It means you stop financing your identity. You stop buying the version of yourself the ad told you to be. The banks built this machine over decades. They didn't hide it because they were embarrassed. They hid it because a debt you understand is a debt you can escape, and an escaped debtor is a lost revenue stream. You were never supposed to know any of this. Now you do.